Okay, you guys, we're now going to take a look at exercise 6-5 on page 350. And here's where we get into some more of a practical application of calculating present value. Let's read through it first. It says the Field Detergent Company sold merchandise to the Able Company on June 30th, 2016. Payment was made in the form of a non-interest-bearing note requiring Able to pay $85,000 2 years later on June 30th, 2018. They go on to say, assume that a 10% interest rate properly reflects the time value of money in this situation. Okay, you guys, they called this a non-interest-bearing note. But what we realize in accounting is there's no such thing as a non-interest-bearing note. Part of that $85,000 in this case is going to be considered interest, because they're not paying us today on June 30th, 2016. They're not paying us cash, or they're not promising to pay on account within the next 30 days, which we would not charge any or record any interest on. But if we're letting them pay us over the next 2 years, then we're essentially loaning them money to make this purchase. And so part of what they pay us 2 years later, part of that $85,000 for accounting purposes would have to be considered interest revenue. Only a portion of it could be considered sales. The portion that could be considered sales would be the present value of the $85,000. Okay, so let's enter it in here. The payment to be received in 2 years is $85,000. The interest rate applicable to this transaction is 10%. Number of periods is only 2 years. So the present value on June 30th, 2016, we'll have to go to our chart, present value of $1. Again, that was on P2 in the back of your book. Okay, we come to 10%, and down to 2 periods, we get 0.82645. And then we're going to multiply by the payment amount. So the present value of that $85,000 to be received 2 years from now is only $70,248. So that's all we could record as revenue or sales, I'm going to call it. Or that's what I'm going to call our revenue account. That's all we could record as sales on June 30th, 2016. So let's look at the journal entries that would be made on June 30th. They don't ask for those, but let's look at the journal entries that would be made on June 30th, 2016, and then on June 30th, 2018 when they actually pay us. So let's go to a journal template. We'll type in June. First, let's just put 2016 here. Alright, then we'll put June 30. Okay, we're going to debit notes receivable. Because what are we doing? We're essentially letting them borrow money. And we're going to debit the note receivable for $70,248. Right here, the present value of the $85,000 to be received in 2 years, assuming that interest rate of 10%. So $70,248. Okay, because that's all we can record as an asset on June 30th, 2016. Because part of that $85,000, since we're not receiving it for 2 years, part of it's considered interest, right? And we haven't earned that interest until the 2 years passes off. So all we can record as an asset on June 30th, 2016 is the $70,248. Also, that's all we can record as sales. We sold some merchandise. We didn't receive cash or even accounts receivable for it, though we did what car dealers would call tote the note. We let the customer borrow the money to make the purchase from us. And even though we're calling that interest-free, in accounting, we don't consider, in accounting, there's no such thing as an interest-free loan. We would just compute the interest on it. You've heard there's no such thing as a free lunch. Well, there's no such thing as an interest-free loan. It's built into the purchase price. All right, so we're going to credit sales for $70,248 as well. Okay. Now, when we get to 2018 on June 30th, you figured it out yet? Well, what are we going to receive, we being Field Detergent Company, what are we going to receive from Able? Well, we're going to receive cash, an asset that increased, $85,000. Our asset, notes receivable, has now gone away. It's an asset that decreased. The same amount that went on the books, that's $70,248. And we're going to credit interest revenue. Some people would call it interest income. Either one could be used for the difference here. So it's going to be equal to 85,000 minus the 70,248. 14,752 is the actual interest on this transaction. So I hope that makes sense, you guys. If we see something that says interest-free note, we have to figure out what the appropriate interest rate should be and record and discount the note receivable and the sales revenue to that amount, make that entry on the day the sale was made. Then when we receive the cash, whatever time period later, in this case 2 years, we debit cash for that amount, take the note receivable off the books at the same amount it went on the books, and then the excess would be credited to interest revenue. Now, on the other side of that transaction, these would be entries for a Field Detergent Company. We could also look at the entries let's put up here for these were entries for Field Detergent Company. Let's come here and make entries for Able Company. Okay, in 2016, on June 30th, you figured it out yet? Okay. On June 30th, they would debit. It says they purchased merchandise. Let's assume it was inventory. So they would debit merchandise inventory. Could have just been merchandise, but I'm going to go with inventory for $70,248. This would be assuming both companies applied the same 10% interest rate, but on a like transaction they probably would. But it does make that assumption. Okay, and they would credit not notes receivable, but the liability notes payable for the $70,248. Then on June 30th, 2018, they're going to debit notes payable that they get off the books when they pay Field Detergent Company. They're going to take it off the books the same amount it went on the books, $70,248. That wipes out the liability. They're going to debit interest expense for the $14,752, and then they're going to credit cash to take it off the books for, should be $85,000, but let's make sure it's the total of those two. And there you go. So you've now seen the entries. They didn't ask for them, but it never hurts to look at some journal entries. Now you've seen the journal entries for Field Detergent Company and for Able Company to do with concerning this transaction. Just remember, in accounting, there's no such thing as an interest-free note. We'll impute the interest even if it says it's interest-free, which is what we did here. Just like there's really no free lunch, right? No free borrowings as far as accounting, as far as the our generally accepted accounting principles would look at it. Okay, you won't have to do nearly that much on this exercise for your homework, but I thought we'd go into it a little deeper. And if you can work out actually this part, you should have no trouble with exercise 6.5. If you have any questions, please be in touch. Thanks.